Hey traders, welcome back to our channel. Today, we're diving deep into a game-changing concept that can elevate your trading strategy to the next level: liquidity inducement. If you're looking to gain an edge in the financial markets, this video is an absolute must-watch. So, grab your notebook, stay tuned, and watch until the end because you won't want to miss a single minute of this invaluable information. Let's get started. Let's start with the basics. What exactly is liquidity inducement? Liquidity inducement is a concept used in trading where larger market participants, such as institutional traders or market makers, create price movements to lure smaller traders into making trades. This is done to ensure there is enough liquidity, or trading volume, to execute large orders without significantly moving the market price against their positions. Your primary goal as a trader is to make sure that you can spot these liquidity traps and align your trades with the market makers to achieve a high win rate. And that is exactly what I'm about to show you in this video. We'll start with the basics of liquidity and then dive into more advanced liquidity concepts that can make you an expert. I'm pretty sure most of us started trading using classic patterns like double tops, double bottoms, and trend lines. Many mentors would teach you that once the price retests your resistance level, you should execute your sell orders with a stop loss above the resistance, expecting the price to push down and hit your target. Similarly, for trend lines, they would advise that when the price retests your trend line for the third time, you should execute your buy orders with a stop loss below the trend line, anticipating the price to push up and reach your target. However, these patterns are well known to every trader, and that's exactly why they are no longer as effective. The market has evolved, and so should our strategies. Since everyone wants to trade these setups, it creates a lot of trading activity in the market. The pile of stop losses you place above this resistance generates a significant amount of liquidity, and that's where institutional traders come in. Remember, institutional traders execute large volume trades, which require a significant amount of liquidity. To access this liquidity, they look for a point of interest situated just above the pile of stop losses. They then push the price to this point of interest, clearing out all your stop losses. With the increased liquidity, they execute their sell orders, and the price will instantly push down, reaching their target. The key thing to note here is that once you spot these areas of liquidity, look for a point of interest situated just near the pile of imaginary stop losses. This is where most professional and institutional traders execute their trades. By doing this, you align your trades with those of institutional traders, significantly increasing your likelihood of a successful trade. Understanding this dynamic can transform your trading strategy and greatly improve your win rate. In this price chart example, we see that the price broke above the previous high, indicating that buyers are still in control. This means we will be looking for further buying opportunities in this market. Now, let's shift our focus to this double bottom. When you see this pattern in the market, I want you to think like the market makers. We know that technical traders will be looking for long positions on this retest, placing their stop losses just below the support zone. These piles of stop losses generate liquidity in this zone, attracting institutional traders to push the price down to the nearest point of interest just below these imaginary stop losses. From here, wait for the price to drop and retest your point of interest while taking out all the stop losses. This is the precise zone where you should execute your buy orders, with a stop loss below and a take profit above the major swing high. The price will most likely shoot up impulsively. This huge candle shows that there is significant buying pressure in the market, stemming from the large volume trades executed by institutional traders. By thinking like the market makers, we were able to align our trade with theirs. These setups occur frequently in the market, you just have to be patient. Here's another example. The price broke above the previous high, indicating that buyers are still in control, and we should look for further buying opportunities. Now, let's shift our focus to this double bottom. Remember, once you see this setup, you need to start thinking like the market makers. We know that technical traders will execute long positions from this retest, placing their stop losses below the support zone. This pile of stop losses generates a significant amount of liquidity, which attracts market makers to push the price down to the nearest point of interest to access this liquidity. From here, wait for the price to push down and retest this point of interest while clearing out all the stop losses. This is the ideal zone to execute your buy orders, with a stop loss below and a take profit above the major swing high. The price will most likely push up impulsively, reaching our target. These large body candles indicate substantial buying pressure coming from institutional traders. By thinking like the market makers, we were able to align our trade with theirs, significantly increasing our likelihood of a successful trade. One common mistake that many traders make is correctly identifying the inducement but then pinpointing the point of interest far away from the inducement. This is not how it's supposed to be done. Remember, technical traders will be executing their buy orders at this price level and placing their stop losses just below the support zone. Therefore, your point of interest should be just below where their stop losses are situated. Similarly, for steep trends, you might correctly identify the trend line as your inducement, but your point of interest is far away from the liquidity pool. Keep in mind that technical traders will execute buy orders at this third retest and place their stop losses below the trend line. Your point of interest should be just below where their stop losses are because that's where institutional traders will be executing their large volume trades. In this price chart example, we have a trend line moving to the upside. For us smart money traders, this trend line serves as an inducement. We know that technical traders will execute buy orders at this retest, placing their stop losses below the trend line. Identify your point of interest just below where their stop losses are and wait for the market to drop and clear out those stop losses. With the increased liquidity, we can now execute our buy orders, with a stop loss below and a take profit above the major swing high. The price will most likely push up and reach your target. These patterns frequently occur in the market, you just have to be patient and wait for the right setup. Here's another example. We have a clear trend line moving to the downside, which represents an inducement for us smart money traders. We know that technical traders will execute their sell orders at this price level, placing their stop losses above the trend line. Identify your point of interest just above where their stop losses are and wait for the market to break above and clear out all those stop losses. From here, execute your sell orders, with a stop loss above and a take profit below the previous swing low. The price will most likely drop and hit your target. By thinking like the market makers, we unlock a new dimension in how we perceive the market. Make sure you understand the concepts shared in this video, as they can significantly elevate your trading game. Now that we've covered basic liquidity inducement, it's time to shift our focus to advanced liquidity inducement. There are situations in the market where you have two demand or supply zones stacked on top of each other, and many traders get confused about what to do in such scenarios. In some cases, the first demand zone acts as an inducement. So how do we know whether it's an inducement or not? It's quite simple. Look for an imbalance in the market. If there's a fair value gap below your demand zone, then that demand zone is most likely an inducement, and all those who buy from this demand zone will be trapped. What you need to do is wait for the price to drop, fill this gap, and clear all the stop losses situated in this zone. Once the price clears all the stop losses and fills the gap, this demand zone becomes the precise area where you should look to buy, with a target above the previous high. In this price chart example, we can see that we are in a clear uptrend, and the price has printed two demand zones for potential buying opportunities. To determine which demand zone to buy from, we need to look for imbalances in the market. We can see that there's a fair value gap below the first demand zone, making it an inducement. Traders who buy from this zone will likely be trapped. Instead, wait for the market to drop, fill the gap, and clear all the stop losses resting in this zone. Once the price retests your extreme demand zone, execute your buy orders with a stop loss below and a take profit above the major swing high. The price will most likely push up and hit your target. Here's another similar example. The market is in an uptrend and has printed two demand zones for potential buying opportunities. By now, you should be able to easily identify which one is more eligible to buy from. We can see that there's a fair value gap below the first demand zone, meaning the price has to fill this gap before continuing to the upside. This makes the first demand zone an inducement, and all those who buy from this zone will likely be trapped. Wait for the market to drop, fill the gap, and clear all the stop losses resting in this zone. Once the price retests your extreme demand zone, you can execute your buy orders with a stop loss below and a take profit above the major swing high. The price will most likely respect your setup and move upwards. This is one of the best setups in smart money trading and retains a very high success rate. All you have to do is exercise patience and wait for the right setup. Another example is when you have two demand zones, as shown in this price chart. However, there are equal lows below the first demand zone that the price did not clear. To technical traders, this is a support zone, and when the price pulls back to this level, they will look for buying opportunities with stop losses below. These stop losses generate liquidity. Additionally, there's a fair value gap that the price needs to fill. With these two conditions in place, it means that this demand zone is an inducement, and all those who buy at this zone will be taken out. The ideal approach is to wait for the price to drop, fill the gap below, and clear the liquidity resting below the equal lows. At the retest of the extreme demand zone, execute your buy orders with a stop loss below and a take profit above the major swing high. The price will most likely push up and reach your target. In this example, we just had a change in market character, indicating a trend reversal. The price has printed two supply zones for possible selling opportunities. However, we have equal highs above the first supply zone that the price did not clear. To technical traders, this zone is a resistance zone, and when the price returns to this level, they will look for selling opportunities with stop losses above. This pile of stop losses generates liquidity. Additionally, there is a gap that the price still needs to fill before continuing to the downside. With these two conditions in place, this supply zone becomes an inducement, and all those who sell from this zone will be taken out. The ideal approach is to wait for the price to fill the gap and clear the liquidity resting above. From here, execute your sell orders with a stop loss above and a take profit below. The price will most likely drop and reach your target. Here's another similar situation. We have two demand zones for possible buying opportunities. However, there are equal lows just below the first demand zone, and we know that these equal lows will generate liquidity in this zone. Additionally, there's a fair value gap that the price needs to pull back and fill before continuing to the upside. With these conditions in place, it means that this demand zone is an inducement. Wait for the price to drop, fill the gap, and clear the liquidity resting in this zone. From here, execute your buy orders. The price will most likely push up and reach your target. That's it for today's video on mastering liquidity inducement. I hope you found these examples and explanations valuable and that they help you take your trading to the next level. Remember, patience and understanding of these concepts are key to aligning your trades with institutional players. If you have any questions or need further clarification, feel free to leave a comment below. I'll be happy to help. If you enjoyed this video, make sure to give it a thumbs up, subscribe to the channel, and hit the notification bell so you don't miss any future update. Thanks for watching, and happy trading.